So let's talk about this 18.6 real estate cycle. Can you explain for the listeners, bare basics, how we believe it's transpires and how history has a habit of repeating itself?
Yeah, all right. So bare basics. There's two reasons why it's 18.6. One is esoteric in nature, probably outside the scope of this. The other one is that for 220 years now, the United States land market has shown a remarkable propensity to repeat. Now, it has a real estate cycle that in that time frame averages no shorter than 17 years, but no longer than 20. So it averages out at about 18.6. So if you're going to describe this cycle to someone new, you call it the 18.6 year real estate cycle, even though it's regarding the average length there for the US land markets. So that's basically the whole cycle research is based on that. And in fact, you can make a good case to me that it should be called the economic cycle, because banks and finance world now are so intertwined with the land market that it's almost indistinguishable, So, but we call it the real estate cycle. I mean, Phil Anderson's book, The Secret Life of Real Estate and Banking, as well, is called that. So I think it's easier for people who are new to the research to grasp it. Yeah, that's the one.
Let's break it down, because there's four phases essentially, isn't there, of that 18.6 real estate cycle. Can you explain that and how that works, and maybe give an example?
Yeah, sure. So if there's such thing as a formula, it would be 14 plus 4 equals 18. So I'll explain that. So the 14 indicates 2 7-year periods of rising land markets in the US. Those 2 7-year periods are interrupted by something we call the mid-cycle recession. It's generally 6 to 12 months in length. Our one for this cycle corresponded with the COVID lockdowns, which I hope we never go through again. And then at the peak, you usually experience something 3 years, maybe 4, depending on just how much speculation has happened before it, of land prices falling down. So you have 14, 7 plus 7, plus 4, which is generally 3 years at the end, plus your 6 to 12 in the middle, and that constitutes your broad 18-year real estate cycle. So you mentioned an example. So as I said there, during COVID lockdown, we were telling our members in December 2019 to expect a slowdown. Certainly not a global pandemic, mind you. We're not that prescient with stuff, but the economy was starting to slow down. It was in line with the mid-cycle recession that we were expecting. So our members were prepared for it. Certainly the pandemic was an additional layer that we didn't expect, but I think it shows, very briefly, a good example of how our research can help our members with time in their investment decisions.
Now, the pessimist out there would say, okay, through this period of pandemic, there were markets that went up, exploded, and there were markets that stayed stagnant, and there were markets that retracted. So what's your, I suppose, response to something like that?
No, I think that's a good point to bring up. It generally relates to, in a mid-cycle recession, what do governments most favour to get the economy back moving again? Now, in places like the US and Australia, and to a lesser extent the UK, the answer is always property. Protect land values. So here in Australia, we had the government come up with means and incentives driven by the banks to cover the monthly mortgage payments for the vast majority of workers. So that was designed to make sure we didn't have a rush of defaults on bank loans. We didn't have tens of thousands of people having to leave the community at a time when we were all locked down, mind you. We all had to stay inside. But there are other countries where perhaps that wasn't the first thing that governments wanted to do. And the pure shock of a global pandemic did have further ramifications on land markets. Suffice to say, each market is different, John, but the outcome was that after the initial shock, they bottom and then they all started rising again almost in uniform. And to this day, that has been the case.
So where in the cycle are we sitting at the moment, Darren?
Okay, excellent question. So what you're asking me, Rachel, is a question concerning timing. I can tell you unashamedly, you will not get the timing of the cycle if you follow Australia. It's actually only one market you can do it. It's the United States. The US leads the world into and out of every 18.6 real estate cycle for over 200 years now. So for us as a business, it's the United States that must be the center of our research because that's where we get the timing from. So from the US perspective right now, we're in year 13 of those 14 years of rising prices. We expect probably this time next year, quite possibly, probably, land markets in the United States will have peaked. Now, if you're in Australia, you might think, well, that's not much use to me. I don't invest in the United States. But you might be interested to know that if you understand the real estate cycle from the US point of view, you'll know that Australia actually has a head start on what happens over there. And so we could expect the Australian land markets, broadly speaking, take maybe our top 2 or 3 capital cities, 6 to 12 months after the US peak, they'll do something very similar as well. So that gives people who study the United States an enormous head start in trying to time something that might happen 6 to 12 months in advance. But for your question, Rachel, that's where we are. We're at year 13. We've still got a little bit way to go, but the end is not.
And what will happen at the end of the cycle?
Well, the world won't blow up. Netflix won't cancel.
Oh, that's a relief.
Yeah, you'll look out your window and pretty much the day after the land market tops, absolutely nothing will change. It's one of the advantages of real estate. Nothing happens quickly. We're not talking about a crypto market or, speculative stocks that can move 50% in an hour, which we've seen already, Real estate tends to be a good old slow moving sort of market. So the stats that we'll be relying upon, they're lagging indicators. So generally, we won't be able to confirm it probably till about 2 to 3 months after the actual event that there looks like there's been a topping out. But at first, there will be very little change rate. You won't notice much at all. But the key will be the stock charts, because those stock charts of the leading US property developers will show very clearly that their earnings are about to drop significantly and that market makers are going to price that accordingly. And that's your first clue.
So when you say stock charts of say developers, for example, is that because there's a credit crunch, they can't obtain lending, or is there an oversupply of land, or what's happening to essentially cause that?
Oh, a little bit of all of that, John, to be honest. It does get to the point where it makes no business sense to continue to bid land prices higher because they just can't make the profit margin that they once did. And then that leads on to obviously the credit question with it, because obviously these land developers do use a lot of credit to purchase this land well in advance of developing it. If the land price basically absorbs all the credit that can be possibly lent against it, then that's it. You've hit that wall of development. And as I said, people who live and breathe analysing stocks, they're generally the first to discover it. We call it the price discovery mechanism of stock markets. And they'll very quickly understand that that's happened, that they've reached capacity, that it does not make any more business sense whatsoever to continue to push the land prices higher because there's no profit-driven motive to do so. And they start pricing the stock prices lower. What we're looking for in this case is what we call a lower top. That's the first indicator that things are about to turn down.
At the moment, I feel as though, Rach, we're in an environment where, literally had an interest rate cut yesterday. Rates are well down on the previous sort of 12 months, 2 years. We've got a high demand for property, real estate in Australia, and we've got an absolute lack of supply, like catastrophic levels that I haven't seen in my short time in life. So when we've got access to lending the way it is now, right, people can borrow money quite comfortably, and we've got massive undersupply of housing in Australia, and a massive demand because people love real estate and people want to buy their own home and investors want to invest and all these things. We're probably guilty of sitting here saying, how can we see any crash on the horizon? And I'm wary to use the word crash, but how can we see this slowing down at all?
Well, that's you've actually highlighted one of the keys of it, is that the reason why it's such a massive shock to the system is because no one sees it coming. Now, unless I'm mistaken, I don't think we've got 25 million members of PSE. We have a few thousand. So 99.9% of the population aren't privy to our research, and they're never going to see this coming. I also push back, and I understand the sentiment. I really do. But I do push back sometimes. I think we need to be more nuanced when we talk about undersupply. Let me explain. If you're talking there's an undersupply of brand new greenfield developments coming to market, I agree with you. And for many different reasons. One is that, we've had an absolute carve out of, developers that have just basically packed it in and no longer in business. But if you're talking undersupply of existing homes, you will find in a few years from now just how many, and I'm talking tens, possibly hundreds of thousands of units and houses that have been deliberately kept off the market that will flood when things turn south and just exacerbate the downside for land prices and the selling pressure as well. I mean, I live here in the south of Canberra. There are dozens and dozens of houses here, and these are like, some of them are McMansions, some of them are 5-bedroom sort of places and stuff. In the 8-9 years I've lived here, I've seen the lights on inside them at night, maybe once or twice. They're just empty, just sitting there. Those types of properties, when things get bad and the owners of them decide it's time to cash in, they'll get released when land prices start to really, really fall, and they just exacerbate things to the downside. So that's why I try to be a little bit more nuanced, even though I understand your sentiment, John, precisely about why you would say that. And I think also because the media narrative, every single day we are told we have not enough supply, we have this, but I tend to look at things a little bit more nuanced and a little bit more deeper than they do.
So when you say deliberately kept off the market, are they investment homes? Are they owner occupiers? And why would they need to sell when it's a downturn or a retraction?
I'm not sure who owns them specifically, because I've actually never had a chance to talk to anyone either leaving or entering them. I just know in my travels around my local area, for instance, and also if you go to Sydney and Melbourne as well, a lot of times, you look at these brand new apartment towers and stuff like that, and only half the lights are on. So, I mean, it's a combination of things. They might be Airbnbs, for instance, although I don't know why you'd have them here in Canberra necessarily. They could be owner-occupier, so they could just be kept. But there's also a very quiet but large swell of international buyers that love to buy Australian property and hold their wealth here as well. And I think that, they're just here for the capital gain. And when it's obvious that capital gain is fast disappearing, they'll sell.
Yeah, so we have had a pretty steady market in Australia for the last 30 years. Do you think that's going to change dramatically in this next cycle? Do you think there's going to be a sudden drop in the market?
Well, the Australian market's funny. I mean, let's be honest. It's a bunch of capital cities really, and then a whole heap of sort of empty land. And if you look at Australia, I view, Sydney, Melbourne, Brisbane, Adelaide, etc., their own little nation states. They all move to the beat of their own drum. They like to do their own things. They tend to either lag or follow, each other a little bit. So when we talk about what could the potential falls be, well, regardless of what market you're studying, it's predicated largely on one single fact, and that is how much speculative credit is created prior to the peak coming in. Now, at the moment, there is a lot of credit being created in Australia from traditional banks to put into property. we believe private equity and credit are also pumping a lot of money in, but they go to great lengths to hide the amounts of that. But let's assume it's quite substantial. So historically, Australian property as a whole, every time we have a significant downturn, I think the average fall is like 12% across all capital cities. Maybe sometimes 15 is particularly bad. So we're not talking about 50% or 60%, some sort of Armageddon scenario. But what I would expect is in these last few years here in Australia, those areas that are on the margins and getting bid up the most will suffer the most egregious losses compared to the more traditional big capital cities that we've got here in Australia.
Yeah, interesting stuff. It has my mind ticking over in all sorts of different directions. I don't know about you, Rach, but let's take a break and we come back. We want to talk about maybe what us as individuals can be doing to mitigate the downside of all this.